Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technical, and crystal ball gazing in that specific order. Today is Thursday, November 14th, 2024. Today's episode, not a lot to talk about. Few sort of interesting things going on in charts, but the data coming out with PPI, how much are producers paying for stuff to make stuff, and then the same metric but without food and energy, and they came out exactly as expected. Basically, the regular PPI being 0.2% month over month, and the core being 0.3% in year over year, the regular being 2.4%, and the core being 3.5%. The biggest direct effect will be on the Fed funds futures. I talked about yesterday how we went back from basically a 60-40 probability of there being a cut or no cut to an 85-14% chance. And today we reverted right back to the 60-40 probability. So now only a 60% chance of a cut in December, interestingly. And looking further out from the CME Group FedWatch tool, we can see still, the bigger picture here is, as of today, again, these numbers can change. They do change. They change daily, as you can see. And the further out you go, the more they have the potential to change. I'm in the camp, as you know, that I am expecting more cuts than what are currently priced in. But very notably, the market is only expecting over the next year a total of 3 more 25 basis point cuts. I'll add to this that this is pretty much how every cycle goes. I hadn't mentioned this before on the show, but it seems every time we get to this point in the cycle, the market's like, we're only going to do like a few cuts and things will be fine. And then things fall apart. And then there's, emergency cuts. They have emergency meetings with cuts as things escalate and fall apart. We're not there yet in terms of bankruptcies, job losses, banks blowing up, that kind of a thing. We're not there. Not yet. Something's coming, though. I see it in my crystal ball. The other thing for today's episode mainly is that next Wednesday we have NVIDIA earnings. I'm not seeing anything else on the market calendar being very interesting. We have retail sales coming out tomorrow and Friday, and then a few smaller things. I think it's the PCE we have coming out. PMIs coming out next Friday. And besides, the PCE is actually one of the more important ones, but nothing major coming out. And so if we do get any major things, it could be caused by the stock market itself. If it starts to really crash, and all of a sudden you have, liquidations, that's when, credit spreads can widen and people realize that things are getting more risky, and things can snowball pretty quickly just from stock market correction. That can really actually be the last straw that breaks the camel's back and starts the whole obvious, feeling of recession, accompanied later by the job losses and all of that. But that's just a crystal ball rating. Again, this week, next week, main thing is really NVIDIA earnings for me. These are the daily reminders that I read through only on every Monday's show. Watch Monday's show to hear a read through of them. One quick little update. We went from a PE ratio of 31 back to a PE ratio of 30. Minimal difference as the S&P 500, the price of it went low enough to get back down to 30. But nothing's really changed. These are very important things to have on the back of your mind. And with them essentially staying the same, the crystal ball readings remain. I should add S here, readings. The S&P 500 currently is priced like it's a Ponzi scheme, relying only on others to bid the price higher instead of proper valuation, and therefore very little amount of safety. Bear market imminent, and the Fed won't cut fast enough to save the economy. No, don't worry, guys. This time it's different, they say every time. And every time it's not different. So, onto the charts, the SPX, the S&P 500. Pretty decent looking down day. This is really, I mean, looking at the shape of it, I called the top. I mean, look, I've said we could easily be at the top many times in this recent bull market. Again, like this top at 6,000 represents a top that matches the top of the dot-com bubble and the 1929, you can call it bubble, on a logarithmic scale. From a basic, charting standpoint, looking at how we popped up so quickly and then went sideways and now we're like rolling over. This is like this isn't like a knee-jerk reaction. This is like controlled selling, which kind of tells me that this doesn't look so much like a bear flag. It looks more like a roll over to whatever resistance lines will be present. The 10-year break-even inflation rate today, with today's data coming in exactly as expected, interestingly moved down a notch today from 2.35 to 2.33, still moving basically completely sideways, not giving us a clue where, we're not trending higher and higher. We're not trending lower. We've been going straight for over a month now. Over a month, just basically completely sideways. This is trying to decide where we go next. As you know, these kinds of charts, they never go sideways forever. I'm not expecting this to continue higher. I'm expecting this to continue lower, but that's just me and my crystal ball. Next, TLT, my favorite place to be. I'm pointing this out every show. I have 55% of my portfolio exposed to long duration treasury bonds, similar to TLT. With this RSI price going down, RSI going up, price going, lower lows, lower highs, and yet higher lows and higher highs in the RSI, still appearing to be a pretty solid bottom of this declining, widening wedge at the bottom of a move down, which suggests that the reversal is coming. DXY, the dollar index, the value of the dollar, moving higher. I've been saying on every show, it looks bullish. It's going up. Therefore, it looks like it'll keep going up until it doesn't. This is starting to like worry me at how like fast and crazy this is going up. By the way, when the dollar goes up, it puts a lot of pressure internationally on other markets, because there's a lot of dollar denominated international debt out there. And so when dollars get expensive and they have to be paid back in other currency, when other businesses that have their businesses in other currency have to sell their currency to buy dollars to pay their dollar denominated debt, it's a problem. A strong dollar can really be disruptive. Very interesting how we just keep climbing here. I'm just gonna gloat for a little bit that, if you were watching my shows when we were at this bottom here, I swear I had watched I pay attention to a lot of people's different viewpoints, and I must have seen at least 10 people calling for the dollar to drop down into the 80s when we were at the 100 mark, and I was one of very few voices saying I wasn't seeing that, and I was seeing this potentially bottoming here, and we are just ripping higher and higher and higher in the dollar. This goes completely against any kind of narrative that there's some kind of like potential dollar debasement, or that people are running from the dollar and the dollar is trash. Like, no, I mean, maybe someday in the future it could be, but it isn't. The psychologically getting to 100, 607. I mean, that's high. Uh, Scrolling out to the past. I mean, let's look at a longer term view of this. Okay, we have the monthly, each bar representing 1 month. And this goes back to 1968. All right, so does this look like a weak dollar to anybody? Not to me. Around this range of 106. In fact, it's on the upper end of it. In 2000, it looks like coming out of sometime during the great financial crisis, we had gotten to an absolute low of 70 in DXY, and it looks like we had a peak in it actually in 1985 at 165. That probably had something to do with the Treasury coupons being like extraordinarily high. If you were locking in like a 30-year bonds in the early 80s, I mean, you would have done yourself a big favor. I mean, in terms of like safety and return, like, oh my goodness. But not a weak dollar by any means. Funny enough, this could actually be the black swan thing that really rolls over the economy, is the dollar gaining so much strength. When the trend's your friend till the end, my question is, where is the end? I have no idea. With Nvidia's earnings coming out next Wednesday, I'm wondering if I drew a new trend line on SMH that made a little bit more sense, connecting August 5th's low to today, basically. And we're sitting on this line, which is appearing to give some kind of support. I'm wondering if we'll be able to crack it to the downside before Nvidia's earnings, or if we'll be bouncing off of this line a little bit more for a little longer. I didn't realize Nvidia's earnings were coming out next week until today, and that certainly will have a humongous impact on the value of SMH, the semiconductor ETF. As you know, if you've been following the show, I'm still holding it, SOXS. It's a triple short ETF on semiconductors, because I believe the industry has gotten out of hand in its valuation. Again, trees can grow tall, they don't grow forever. And at the end of the day, these guys aren't selling anything that, you need a salesman for. This is like, who's got the cheapest ones? Okay, let's go with those. It's like purchasing sand or copper or gold. It's the same stuff. Everybody's got the same stuff. Nobody has an edge. And so this market is competitive. And once you have overproduction, these stocks will all become value stocks, and they will be a lot cheaper than where they are today. In the future, I believe we will see PE ratios similarly to where we see car manufacturers being, sometimes being as low as 5 or even lower, not in the hundreds, or, over 50. Yes, 1/10 of that valuation. So I'm excited about the market, perhaps waking up to this reality. Again, with a lot of speculation priced into companies like Nvidia, they need to show, more growth of earnings, explosive earnings. And if they don't, then the market wakes up pretty quick, and the speculative value can disappear pretty quick. And when you have a lot of speculative value, then the price can drop very, very, very far to the downside. And this is my expectation. I show this on every show, but it's the very big head and shoulders top with all of these engulfing bearish candles. This one was apparently as rare as as great as finding a white whale for a trader, a double engulfing candle at the very top of a market. And yeah, we have a head and shoulders looking thing that looks like it's going to get down on the neckline, and I'm guessing crack through and go much lower, and perhaps bring all markets down with it. But if things are showing any evidence of cracking down already, would maybe leading the way, still looking bearish. I've been talking about this head and shoulders thing that we correct to the downside. We confirmed this is with very high, very, very high probability headed down to $73 on the ETF wood. I'm finding it very interesting and very notable that with CPI data and PPI data showing that, we're not, okay, are we still headed towards 2% inflation? I mean, the 10-year break even rate is showing us basically flatlining at 2.3%. Kind of, there's a battle there. Whenever a market's going sideways, there's a big disagreement. There's a lot of participants saying and paying for the idea that it's going to go higher, and there's lots of people saying the opposite, that it will go lower. Now, interestingly, over the past, I guess it's about a month now, we've been going solidly down in the price of silver. Remember back here when we were just higher high, higher low, higher high, higher low, and then all of a sudden silver getting to a peak of almost $35. There was a lot of people getting really excited about silver at that level. And I was saying at that point, yeah, it looks like it's a bull market and it looks like it keeps wanting to go up, and I want nothing to do with it because I'm a value investor and it doesn't look very cheap to me from a historical perspective. It looks a little expensive. And so, why would I think about participating? And, this is why it's good to, this is one of the big advantages of being a value investor. You never get trapped at buying the top. As fun as and as profitable as momentum can be, you don't have to worry about downside risk as much. So silver, I mean, this is just falling, and this is not we're no longer in this higher low pattern by any means. At best, we might be going sideways for a while, but this move downward is looking fairly bearish to me. And then we have a similar move in copper. Here we go. Sorry. With this recent data coming in as expected. So, you have the as expected numbers, but then, certain markets were thinking like, oh, inflation's probably going to actually look hotter than this, and it wasn't. And so they are reacting accordingly, going down. Of course, copper going down also has a lot to do with China. I mean, all of these commodities, silver, copper, gold, these are worldwide markets, not national markets. So, it's a little more complex than just what's going on in the U.S. But then again, back to the other side of this. This is this market priced in dollars, and also with the dollar ripping higher, it's natural for metals to drop here. Any way you look at it, this is not looking inflationary for the dollar against metals. I mean, this is bearish. Copper is dropping in price pretty strongly. I mean, interesting. We got up to a peak of 472 very recently in copper, and now only at 412. Gold also just dropping, and when we're in these kind of bull markets going higher and higher, I sit on my hands as a value investor and I say, oh, I really hope that everyone buying gold right now can sell it to somebody else for a higher price, because that's what you need when things are getting expensive. It's a Ponzi scheme. It turns into a Ponzi scheme where the value isn't increasing. Gold hasn't suddenly become more valuable. It's gold is still gold. It's just the price that has gone up. And at all-time highs, anything at all-time highs can't be considered to be safe because there certainly is a lot higher risk of the price going the other way. I mean, it really is that simple. And gold has been dropping kind of precipitously lately. A lot of large red candles, getting to a low of 2,500 intraday today. last chart of the day. Sorry, but not sorry. I'm gonna bring it up again. Junk bonds spreads only at 2.64. Investors are willing to put their money at much higher risk for much lower added yield than what they normally will pay for extra yield. And as I said before, it's amazing how markets can get so complacent. And like in May of 2007, there were investors purchasing junk bonds for only 2.46% higher yields than treasuries. And then look at what happened to the value of their junk bonds. With the spread getting to 20%, you would not be a very happy bondholder in that situation. It's amazing to me that junk bond credit spreads can even ever get this tight. It's not like I'm the only person that has this data available. I mean, who's buying this stuff? The market just, it's like, no, there's zero risk. There's zero risk when things are this tight, which means to me that's like a big time alarm bell for me. But that's all from me and my crystal ball. Hope you enjoyed and see you next time. Robschild.